pretty good viewpoint of what this is about. And as we go, what you may want to do is maybe mute your phones in the short term, because we tend to pick up some background on that. And then towards the end, unmute your phones and we can do some Q&As if that's all right. Would that be okay with everybody?
Sounds good.
Yeah, I already muted it.
Okay, all right. Well, very good. Well, thank you again so much for joining us. So, as you all know, there's a real need in the market right now as a result of some changes that have been come about as the Affordable Care Act, and I don't think it takes rocket scientists to figure out that our health insurance premiums just continue to rise, and I'm not exactly sure right now that the Trump administration is going to be able to solve those issues. So we're just kind of figuring that it's going to be business as usual for a while further. But employers, are definitely looking for alternatives that are going to cut their fixed costs without reducing benefits. We know that 80% of large employers are now self-funding or doing some form of self-funding for their health benefits. They use stop-loss insurance to do that, and the administrative services of either a carrier or a licensed TPA, a third-party administrator. Again, you guys know enough about benefits to know that self-funded plans have been popular because they avoid many of the taxes imposed upon fully insured plans, certainly at the state level. Self-funded plans aren't subject to the various state benefit mandate laws. They can be custom designed, but have to meet the minimum value standard of the ACA. We've talked about that in the past. And it's important to know and understand that contributions that an employer makes into a self-funded plan are fully tax deductible under federal laws of business expense, just like they were buying fully insured coverage. There are different laws under ERISA that apply to self-funded plans than to fully insured plans, but the contributions are still tax deductible. And that is something that's been debated over the years about whether or not these self-funded plans would remain tax exempt. And right now it appears that that's going to continue on in the foreseeable future. We also know that now almost 50% of mid-sized employers are now implementing some form of a consumer-directed plan that might involve some sort of alternative funding in which the employer might take upon some form of risk, such as an HRA or an HSA or an FSA. Those are not new terms. They've been around for a while, but we've seen a real growth in among mid-sized employers, and I say mid-sized, 50 to about 200 lives is considered in the mid-sized market. And we've seen a lot of those employers just dump their old traditional plans and go to an alternative funding or consumer-directed plan. And then we also now know that some of the advantages of this alternative funding can be available to small employers under the ACA. So with that being said, what's the need? What's going on? Stop-loss insurance is nothing new. It's been around since the 1970s. Typically, sales of stop-loss were restricted just to large employers who wanted protection from very high claims. Back in the 80s and the 90s, there were new types of stop-loss insurance coverage that were introduced in the market so that it would be available to mid-sized employers with 50 to 500 employees. And then, prior to 2014, these stop-loss products were also introduced through a method called level funding, and I know that we've talked about that in the past with you guys. That's a package of stop-loss insurance, administrative services, and a guaranteed maximum funding exposure so that small and mid-sized employers can do that, and it looks and smells like a fully insured plan, but it has all the benefits of self-funding and the protection that protects them from, obviously very, very high claims. January 1st, 2014, California enacted SB 161. It restricted the sale of stop-loss insurance to small employers And today, there is a minimum specific and aggregate requirement in California. So if you buy a specific stop loss and you're a small employer, the lowest specific stop loss deductible you can buy now is $40,000 per person. And on top of that, the minimum aggregate stop loss, the umbrella policy that most small employers will buy, is now limited to a minimum of $5,000 per person per year. So both of these things were enacted by our brilliant legislators to try and discourage small employers from doing any sort of self-funding. Obviously, certain carriers with a political agenda are effectively trying to prevent small employers from leaving the fully insured market and going self-funded. You all know that January 1st of 16, California enacted SB 125, which increased the definition of small employer from 2 to 50 to 2 to 100. And now the count of employees, or the definition of employee size, is based on the number of full-time equivalent employees, much like the way we've done it for ACA calculations, and you're all very familiar with that. So the good news is that a number of small group carriers have lifted their prohibition against allowing small employers to establish an HRA wrap plan. I don't know if you've heard, but recently our friends at Anthem Blue Cross lost a lawsuit in a superior court, and that lawsuit was to prohibit them from, to do away with their prohibition against wrapping. I don't know, what I've heard is that Anthem has basically now modified their master applications, and they no longer require the employer to sign a letter of understanding which prohibits an HRA wrap. And so that's fairly recent news, just the last few weeks. Last summer, Blue Shield of California did away with that same prohibition, and most other carriers now are taking the same position, that if a small employer wants to buy a high deductible plan, they can do so and do a wrap. They don't endorse it, and in fact, I want to make this clear. Our friends at Blue Shield, and as you know, we're a GA for Blue Shield, they do not openly endorse HRAs, but effectively, by doing away with that letter of understanding requirement on the master app, they are effectively saying, if you're going to do an HRA, just don't tell us about it. So be it. So we're happy to announce this employer excess loss insurance coverage. I think we talked a little bit about this last fall when we were still in final negotiations with Lloyd's of London to bring this out. But basically, this is a special product designed for employers of any size who need risk protection that traditional insurance is not going to provide. And there are two applications for it that we're going to talk about. Employers who want to do an HRA wrap plan alongside of a high deductible plan can and should use employer excess loss to limit their overall claims exposure. And then small employers who are unable to purchase an appropriate level of stop loss insurance for their self-funded plan, this SB 161 issue, can also purchase excess loss insurance, because excess loss insurance is not filed as stop loss insurance. It's a different product than stop loss insurance. The coverage that we're writing is underwritten by an A-rated non-admitted carrier, and as I mentioned earlier, that's through Lloyd's of London, through the Kiln Syndicate that we have an arrangement with. And it's written as a surplus lines product here in California, subject to a 3.2% surplus lines tax. And it is a product that we put together with a firm called the iSolutions Group, and it took us over a year to get this all done. So let me just give you a real quick example of an employer who's doing a high deductible health plan HRA wrap who doesn't have employer excess loss. This is based on a small employer in the Sacramento market, 95812. This employer has approximately 50 employees, 35 which are single. On their current plan, represented in the gold column, they have effectively a gold benefit plan through carrier ABC, and you can figure out who that is. It's a gold PPO plan, has a $500 deductible, 20% coinsurance. Again, an 80% coinsurance with a $4,500 maximum out of pocket. It's got your traditional first dollar benefits for preventive care, office visits, urgent care, etc. And their average rate, remember their rates are based on member level rating, but their average rate was $522.71 a month for single, $1107.17 for two-party with spouse, $894.90 two-party with child or children, and $1582.44 a month for employee with family. So their total monthly premium was coming out to $36,217, which is an annual cost of $434,000. Their renewal, the renewal that we're looking at, effectively was increasing their costs from up to about $486,000 a year. I wouldn't say that it was necessarily a bad renewal, but again, it was what it was. That employer then said, I want to look at what a high deductible bronze plan will cost us. In this case, we showed them a plan through another local carrier. It's a bronze plan. It's HSA qualified plan, $4,500 deductible, 60% coinsurance, and a $6,500 out of pocket. The only first dollar benefits it had were preventive care under the ACA because it's an HSA qualified plan. But the price of that coverage for that high deductible was quite a bit less than what they were going to pay for a gold plan with with carrier ABC, and that came out at $191,554 a year, $15,000 a month. I'm not making up these numbers, guys. This is the real thing. This really happened. The employer said, I want to put in an HRA. I want to put in an HRA that reimburses my people 80% of whatever their out-of-pocket costs are. So 80% of that was effectively a $5,200 a year maximum benefit, 80% of $6,500, which meant the employer's potential claims exposure on the HRA could be as much as $338,000. If you took $5,200 of claims exposure times the number of singles and twice that for the number of families, that meant the employer's potential claims exposure was $338,000. We predicted that his actual paid claims would be more like $135,000. That's based on the plan design that he had and our experience that we have with groups of this size with these plan designs, and we're pretty good at predicting what those claims are like. In this particular case, the employer, would budget the full $338,000. We expected them to pay $135,000 in claims. They'd pay an additional $18,000 a year for administrative costs and one-time plan document and setup fees. So the total annual cost of their HRA benefit on top of their high deductible plan was $358,000, and when you add that to the high deductible premium of $191,000, that meant that their total overall cost could be as high as $550,054. There are some employers who are willing to risk that. They're willing to say, I don't believe that my claims will be as high as you're saying, and we agree with them. We don't either. But there are other employers who say, look, if that blew up in my face, I don't want to pay that kind of money. So you have employers that will say, basically, I don't want to do it for that reason. So along comes our excess loss product, and here's what it does. It's the same numbers that we saw on the previous page, but what happens is this employer buys an excess loss policy that now limits his total annual claims exposure. Instead of the $338,000 figure, that claims exposure is now limited to $169,000. We also predicted that his paid claims will be $135,000. He'll pay $34,882 for excess loss insurance premium, and he'll still pay $18,000 for Administrative services, $2,500 for plan documents. So his total HRA plan costs is now capped at $224,582. On top of that, the high deductible insurance premium, $191, and his total costs are limited, guaranteed and limited at $416,136. Now, what do we think will happen? Well, if the employer does this, obviously he can go into it, he can budget his maximum cost that first year, and after they have 2 or 3 years of experience, they'll probably drop the excess loss coverage and just go naked without it because their claims are somewhat predictable. But that's the first application of what excess loss will do, especially for an employer with less than 100 employees. So they're buying high deductible, fully insured coverage. The bottom line is that we're continuing to see a substantial premium difference between platinum and gold level benefits and silver and bronze plans. We have been seeing, for example, the difference between platinum and bronze to be, in many cases, 60% of a price break. Between gold and bronze, we're seeing 40 to 50% of a price break, and that's been pretty consistent since 2014 when the new rating system came out. So, if these savings and fixed premiums can fund most, if not all, of the employer's risk assumed when they set up an HRA, and the administrative service fees charged to do an HRA, and you guys know about this, this is nothing new, they're still a fairly low percentage of the total overall cost. About half of the HRA plans that we're putting into place are using traditional claims payment, and the other half are now using a debit card. So the administration on this is fairly succinct. It's not overly expensive, and it does the job that the employer wants to have done, which is have a third party take care of all the paperwork and transactions. So we think that employer excess loss in this particular instance is affordable. For every dollar of benefit purchased, the premium is about 20 cents on the dollar, plus about a 3.2% surplus lines tax. It allows the employer to budget their share of claims risk. It can be used with any high deductible health plan product offered by a carrier who permits HRA wrapping of their products. And as you know, we are a GA for CalChoice. CalChoice no longer requires the use of a letter of understanding prohibiting wrapping. And we think that the old arrangement that they had with Anthem Blue Cross requiring that form is also going to be going away now that Anthem lost that court case. So, we do a lot of wrapping with CalChoice products now because they have good, low-priced, bronze, high-deductible plans. It does require the use of a licensed third-party administrator to administer this. And as I said before, coverage is issued by an A-rated, non-admitted carrier, in this case, Lloyd's of London. And we have a surplus lines broker partner involved with this, so we take care of the taxes for you. And we're paying agents basically a 10% commission on the sale of this product. So in that earlier slide where you had $34,882 of annual premium for surplus lines coverage, there's a 10% broker commission built into that, or $3,400 a year. So that's the first application of how this excess loss will work for an HDHP HRA plan. Now let me give you the second application, this example 3, where a small employer wants to self-fund, but they have problems with this SB 161 law. And again, taking the same employer and the numbers that we had, I think are fairly indicative of the typical small employer. He's going to pay, as we said before, currently he's paying $434,000 a year for a gold plan. That renewal is going to go up to $486,000. Now we begin to run into some issues. In this case, we showed Starmark using the Aetna PPO provider network, It was also a gold PPO benefit plan, $500 deductible, 20% coinsurance, etc. Out-of-pocket maximum of about $4,000. Not exactly what they had, but pretty close. In this case, because of the minimum aggregate stop-loss requirement of $5,000 per person per year, their overall cost of level funding was maxed out at $551,000 a year, which is obviously a lot higher than what their current and renewal cost would be. Internally, in the self-funded plan that they bought, again, because of SB 161, they had to have a $40,000 specific stop loss. It included what we call a 12/21 contract for allowed for a 9-month runoff of claims. But their aggregate claims fund, again, was based on this requirement under SB 161 of $5,000 per person, and that meant $375,000 of potential claims exposure to that small employer. And we believe that their actual annual claims exposure was going to be only about $107,000 based on what Starmark had predicted under if they didn't have to comply with SB 161. So effectively, SB 161 effectively, put almost a $250,000 penalty on this small employer because of their size to comply with the law. So it doesn't work. I mean, self-funding for small employers effectively was not working because of SB 161. So now let me show you what happens with excess loss. In this particular case, we have the same arrangement as before, where Starmark issues a policy that has a cap of $551,000, as we already said, but and it has the $40,000 specific, and it has the annual aggregate fund of $375,000. But when we go in there, we buy an employer excess loss policy that provides a 50% benefit. So it effectively says to the employer, if your claims exceed $187,500 in the year, we will cover all of those claims until they reach a total of $375,000. So think of it this way. There are 3 layers of protection here, and I want to be clear on this because it can be confusing. In this particular instance, the employer is going to be responsible for the first $187,000 of paid claims during the year. Lloyd's of London is responsible for the next $187,500. And when claims reach $375,000 for the year, the stop loss carrier, in this case Starmark, takes over with their aggregate stop loss. So the employer has a net overall claims exposure and cost of $402,662. And I will tell you that we go out now and we're quoting on dozens of groups every week that are coming to us and saying, we want to do level funding, we like it. How will this employer excess loss work? We put that in there and it works great. In fact, our largest case that we wrote with this recently was a group down in San Diego. They had 130 employees, but for whatever reason, their aggregate stop loss was very, very high because they didn't have any prior claims experience. So we went in with with the employer excess loss product, put in a risk layer underneath what the carrier was proposing, and effectively limited their overall costs to about what they were already paying with their current carrier, which happened to be Blue Shield of California. And at the end of the day, they went into this deal knowing that they weren't going to pay any more this year than they would have paid by staying with Blue Shield. And at the same time, if they have a surplus year, things go right, they have a surplus, they get that money back. If everything went wrong that could go wrong, they wouldn't be out any more money than what they had been paying with Blue Shield because of the way we layered this excess loss coverage in there for them. So there are some real practical applications here for both small and large employers who can't get a competitive aggregate stop loss attachment point to limit their overall claims exposure. And now employer excess loss comes in and really makes a difference in that. So what's the bottom line for small employer self-funding? Well, again, as I said, employer excess loss bridges that gap between what the aggregate stop-loss insurer will provide and what the small employer can afford. Each case is going to be different based on plan design, enrollment, and cost of coverage. And the best case scenario is typically it's going to limit the employer's overall cost to their current level of the in-force insured plan. That's our goal in this. I will tell you, we do lots of quotes, and we do not try to do a quote that's going to give them a fictitiously low first-year rate. That's just not the way we operate. Our goal is to try and show them here's a self-funding arrangement that will cost you about what you're paying now or what your renewal is going to be, and all things being equal, you got nothing to lose and something to gain by doing this. We like the fact that the administrative service costs are still a low percentage of the total overall cost of coverage, and we like the fact that we can use typical provider networks such as Aetna, Cigna, First Health, and others. We are working on a couple of arrangements that use the Blues network. Those are not quite in force yet, but for the most part, using Aetna or Cigna throughout California seems to work really well. Outside of California, we have access to other PPO networks. So again, employer excess loss is affordable. Again, the premium is roughly 20 cents on the dollar plus the surplus lines tax. It allows the employer to budget their share of claims risk. It can be used with any stop-loss carrier product. It does require the use of a licensed TPA. It's still written by an A-rated company, again, Lloyd's of London, and we're the exclusive distributor, and we still pay a 10% commission for the sale of that product. So let me then, I want to add one other thing that I was not going to do, but I think it's important. How many of you, well, I know you're on mute, but you probably heard of the term reference-based pricing. And I'm not going to today go through a long presentation on reference-based pricing, but I want to bring it up in the context of these self-funded plans because most self-funded and level-funded plans now feature an option to use the reference-based pricing product. What we're seeing is this. If you go in and you show a reference-based pricing program as opposed to a traditional PPO, we are seeing savings of between 8 and 20% in overall costs. And those savings, again, it depends on what part of the state they're in and what healthcare costs are like, but even an 8% savings is nice. Reference-based pricing administrators are reporting much deeper claim savings than what a lot of stop-loss carriers are assuming. And let me give you a simple example. I went to a seminar recently in Tucson, Arizona, sponsored by the Self-Insurance Institute of America. They had a panel of reference-based pricing and PPO administrators, and they had a lengthy discussion about the savings that's being generated through reference-based pricing. And just so we're clear, reference-based pricing has to do with paying a provider a percentage of Medicare as opposed to a traditional PPO fee-for-service arrangement. And what we know is this. Providers who enter into reference-based pricing typically agree to eliminate a balanced billing provision, just like they do with Medicare. We know that today, 92% of healthcare providers are accepting Medicare fee reimbursement since the enactment of the Medicare Modernization Act 2004. And that means that 92% of healthcare providers have agreed that they will not balance bill their patients between what they bill and what Medicare is paying. And in many cases, that is a huge difference. So they've agreed with Medicare, yeah, we'll accept Medicare payment and we'll agree not to balance bill. Well, what reference-based pricing is doing is going to those same providers and saying, look, how about we pay you a percentage of Medicare and you agree not to balance bill as well? And there are some cases where occasionally a provider will balance bill and they'll go back and they'll negotiate with the provider and say, hey, look, you know, we agreed to pay you 150% of Medicare. You know, are you going to accept that? and back and forth. What we're finding is that less than 0.2% of all claims under reference-based pricing actually end up going to court or arbitration because of a balanced billing dispute. So there's a high percentage of these providers that are accepting reference-based pricing now. More in certain parts of the country than others, but what we're seeing is that clearly in California, reference-based pricing is beginning to take hold. And in rural areas like the Central Valley in Northern California, we think that reference-based pricing is posed to make a huge impact on healthcare costs. So I wanted you to know that because you're going to see proposals from us for self-funding and level funding that will include this reference-based pricing option. We think it's important. For more details about reference-based pricing, you can join us in one of our Friday Lunch and Learn webinars or visit our YouTube page. If you just go to YouTube and do Google Shepler Fear General Agency, we have all of our presentations now posted on YouTube, and the one on reference-based pricing, which was just recorded last week, is there. It's about 30 minutes long and then 5-6 minutes for questions. So honestly, if you want to get ahead of the competition who are still out there selling traditional PPO products, we think that you ought to be having discussions about reference-based pricing with your clients. So in conclusion, coming back to employer excess loss, you know, we think that the market's primed for the introduction of this product because and other changes because of what's happening due to the ACA. You can use this product along, you know, with HRAs. You can use this for small employers who need a competitive aggregate stop loss but are prevented from that because of the law. And it's available for sale now in other states. We're selling this across state lines. Again, it's available through a not admitted carrier, sold through the surplus lines market, and it became available for effective dates beginning January 1st, 2017. So our sales were probably up to about $180,000, $200,000 of premium that have been sold and about $1.5 million of benefits, excess loss benefits that have been placed. So if you want a quote on this, it's best to contact Jennifer here in my office or your local Shepler Fear sales rep, and in your case, you know, myself or Dave Jr. are both taking care of things. So let me ask, unmute your phones, and if you've got some questions, feel free to throw them at me.
Dave, this is Dean. Does the this new sort of stop loss insurance under Lloyd's of London that basically cuts the amount of exposure in half, that doesn't violate SB 161 by changing the amount of stop loss exposure for the company?
No, it does not, Dean, and we were very careful when we went out and designed this because it's been filed not as stop loss insurance, which is what SB 161 specifically references. It specifically references specific and aggregate stop loss, and we had this filed as employer excess loss, and the calculation of the excess loss benefit is not done the same way as aggregate stop loss is done. So it's a much different calculation format, and so far that has been an acceptable deal. We've had no problems with that.
Okay. Who's the TPA? You referenced that there must be a TPA. Do you have one that you have to use, or can they use anybody?
You can basically use anybody you want. We just expect that the TPA will collect the premium and then remit it to us, and then we pay the surplus lines tax and everything here. If the employer says, look, I'm not going to do a TPA, I'm going to self-administer this, then we would probably have to enter into an agreement with that employer for them to agree to, you know, remit premiums on, you know, certain head counts and things like that. But we're open to, right now we have arrangements with 5 or 6 different TPAs throughout the state that are willing to administer this.
Okay.
You guys work with ASI and Fresno on HRA?
Yep, they were our first ones to do this. Yep.
How about capital? with reference-based pricing, I've heard Capital is gaining a lot of traction. Do you have any workings with them?
Sure do. Sure do. Dave Reynolds and I have known each other a long time and done business together. You know, they're now owned by Lucent, and I don't know if you guys know him or not. Mike Tate is now their new general manager, and they're here in Rancho Cordova. So we do a fair amount of business with Capital, BRMS in Folsom, Coastal over in Salinas, Dean, down the road from you, Sterling Administrators up in the Bay Area, and then we're in negotiations with a couple of TPAs in Southern California whose names I cannot mention yet because we haven't signed the deal. But ASI was our first one, Josh, and we do a lot of business with them.
Hey, Dave, I got a quote, from Dave Jr. on this Marketplace Advantage BRMS Gerber Life Cigna Network product, and
yes.
It was very competitive. It was basically tied, but they just decided they'll just stick with Aetna fully insured renewal. I can understand why they did that. I'm wondering, though, how this Marketplace Advantage product is competing against, using excess loss coverage or even, reference-based pricing, maybe with excess loss coverage tied in together.
Yeah, our Marketplace Advantage product is it's obviously a private labeled arrangement that we have, and we actually involve several TPAs, including BRMS, and several stop-loss carriers, including Gerber, Cabot, Transamerica, and others. So we actually work with several different TPAs and stop-loss carriers, all of which, and in fact, the one that we did in San Diego that I was mentioning, that was written through Marketplace Advantage. They chose to use the Cigna provider network instead of Aetna, and they chose to buy the employer excess and the aggregate stop loss as a package. So each package is kind of custom designed for that employer. It isn't just necessarily an off-the-shelf cookie-cutter deal.
Okay, I'm wondering if this Gerber Life proposal that I got included excess loss. I didn't say anything about it in the proposal.
I don't know that it did. I'd have to look at it again because I haven't personally seen it. But if was this a large employer over 100 lives?
Yes.
Okay, it probably didn't. If the aggregate stop loss that was being proposed was competitive, then it probably just did it with that. Typically, if it's a small employer of under 100, then we'll have excess loss involved. Or if it's a larger employer over 100 that doesn't have credible claims experience and we have to use a manual aggregate, that's when we'll get excess loss involved.
Got it. Okay, that makes sense.
Okay. That's a good question. Nobody's asked that before, Josh. Thanks.
Hey,
other questions?
You're starting to be successful with the excess loss? I mean,
yep.
In the 50 to 100 life size group, that seems like the sweet spot, right?
Yep, that's where it was meant to. That's where it was meant to be, and yeah, it's coming along. I mean, it's like everything else. This year, the product rolled out January 1st, and we had some sales in the spring, and we're doing a lot of quoting in the summer. We expect to be extremely busy this fall. And that's one of the reasons why we wanted to give you guys an opportunity to kind of hear about this now, because I think as you go out and begin to talk to your clients prior to their fall renewal, you need to know that you've got this in your back pocket that most of the competition is totally unaware of, okay?
Dave, this is Nelda. Is there what type of application? Can you send the application out for this, or is it just the standard one that we've been sending to you?
Yeah, you just use the standard form that you send to us, and then each application for excess loss coverage is actually generated on a template that we have here in the office. We fill it out and then send it over, because we have binding authority with Lloyd's It's a lot less of a complicated process than what you would normally experience. But I would just use the standard request for quote form that we use now.
Okay. Thank you.
You bet.
When it comes to the removing of these rules on the HRAs now with these other carriers, Blue Shield, Anthem, do you think they're going to start really accelerating the increase on their large deductible rates like they did when Benelec first hit the scene?
You know, Dean, that's a really good question, and you know, I thought that was going to happen in 2014 when effectively the market really opened up, and you know, at that time you had all the carriers except for Cross and Shield who were agreeing to allow for wraps. Okay, and so we thought that in the 2015 renewal cycle, because we wrote so many groups that were doing HRAs in 14, we thought that their renewal cycle in 15 we'd probably really get hit. And you know what? We didn't. We didn't see a substantial increase in rates other than, you know, just the normal trend line. And we didn't see it in 16, and we're not seeing it in 17. And I think part of it has to do with the fact that the carriers, you know, they can no longer do, you know, risk adjustment factors, which, you know, it's been that way now for 4 years. And at the same time, you know, they have to really pool their entire block of business together, and they're under the ACA, their rating structure is very limited as to, you know, what they can, you know, deviate from. So it's to our advantage because of this continued pricing difference between a bronze and a gold plan of, you know, 35, 40%, sometimes 50%. I keep waiting for the other shoe to drop, and it's not dropping. And I think part of it is the fact that if they increase the rates on their bronze product, they have to, unfortunately, increase the rates on their gold product, and they're not selling a lot of that, and they're not happy about it. So, you know, I think they kind of caught themselves in a pickle, and I think the ACA put them there. And that's to our advantage, obviously.
Yeah, speaking of government regulations, if the wingnuts in Sacramento get this single payer through that's more restrictive right now than communist China, do you think that this type of any self-funding plans under ERISA are going to be exempt?
Well, you know, Dean, that's probably a discussion for another day, but I'll tell you this. They've got a huge mountain to climb in Sacramento to get not only federal exemptions, but also exemptions against ERISA, because what they're proposing right now is that all employers and all individuals would go into the state plan, and that you would not have any exemptions whatsoever. And of course, they're asking for, you know, the federal Medicare money to go to the state, the federal Medicaid money, and all this employer money that's being paid on self-funded plans or fully insured plan premium, that all gets directed to the state. So do I think that they'll get an exemption from the feds? Probably not from this administration. But, you know, there are a lot of goofy things going on out there, and I'm not willing to hold my breath because this thing has kind of a life of its own.
Well, I'm just wondering if it might be a good time as an added incentive for smaller employers to look at partial self-funding or self-funding to say, you know, right now ERISA basically supersedes California law, and if something happens in California and you're an ERISA-based plan, you could see yourself outside of the reach of California government.
You know, that's actually a really good point I hadn't thought about, but I think that's a good discussion to have with our clients to say, hey, you know, we know that federal law is what it is, and the states can't touch federal law, and if you go to a plan, self-funded plan that's, you know, stringent to federal instead of state law, you're going to be exempted from these state requirements. You know, what concerns me is how far these idiots, or as you call them, wingnuts in Sacramento, are willing to go to get federal exemptions to take this over. So, but I agree with you. That might be a really good approach to talk to employers about that. Say, look, you want to avoid anything you can with the state right now.
When it comes to the examples in your PowerPoint presentation, they were all excellent. I was wondering if you could send us copies of those examples, because I think they're great illustrations of what the advantage on an average basis for a company looking at this stuff would find.
You know what I'll do is I'll send you out a copy of this entire presentation. Okay.
Okay.
Happy to do it. I'll try to email that out to you later today.
Okay. Great. Thanks, Dave.
All right, guys. Anything else? Well, look, listen, I sure appreciate you taking an hour out of your time and putting up with me and listening on this, and hopefully we can write some business and do good things for you and your clients this summer. All right? Take care, and thanks so much for your time. Bye-bye.